All right, welcome to The Explainer. Today, we are jumping into one of the most powerful data-backed stock-picking strategies ever created, CAN-SLIM. If you've ever wondered what really separates the stocks that just explode from all the rest, well, you are in exactly the right place. Let's get right into it.
So, this is part 2 of our 8-part deep dive, and we are kicking things off with the very first letter, C. Now, according to the system's creator, William J. O'Neill, this isn't just another letter in the acronym. Nope. He says it's the most crucial one. Think of it like the powerful engine that drives the entire CAN-SLIM machine.
So let me just ask you a question. What is the single most powerful fuel for a stock's price? I mean, is it a great story? Is it some hot new trend? Is it a so-called bargain price? Well, the data shows the answer is actually way more direct. It's explosive profit growth. And that, my friends, brings us right to the heart of the letter C.
The C in CAN-SLIM, it stands for current quarterly earnings per share. This is all about what a company is doing right now, not some promise about the future. You can think of massive earnings growth like a giant flare shooting up into the sky, signaling to the big institutional investors that something really special is happening. And it's their huge buying power that ultimately sends these stock prices into orbit.
Now, before we go any further, let's just do a quick definition of our key term here. Earnings per share, or EPS, it's a beautifully simple but incredibly powerful metric. All you do is take a company's total after-tax profit and you divide it by the number of public shares out there, and boom, that tells you exactly how much profit belongs to each individual share. Simple as that.
And I really want you to let this quote sink in. O'Neill doesn't say this is just an important factor. He calls it the single most important element. I mean, think about that. Out of everything you can possibly analyze, debt, management, industry trends, he puts this right at the very top. This is the bedrock of the entire system.
Okay, so we know that strong earnings growth is what we're looking for. But how strong is strong enough, right? The market doesn't really reward vague feelings. It rewards precise rules. And that's exactly what CAN-SLIM gives us. So here it is, our first hard rule. O'Neill's historical research of the biggest stock market winners of all time, it revealed this crucial pattern. Before their huge explosive move, almost all of them showed quarterly earnings growth of at least 18 to 20% year over year. You should consider this the absolute minimum, the ticket you need just to get in the door.
But listen, 18% is just the starting point. If you really want to find the true market leaders, I'm talking about the stock market supernovas, you've got to raise the bar. The pros, they often set their minimum at 25%, 30%, or even higher. See, they aren't just looking for good companies, they are hunting for the absolute best of the best. And this slide right here perfectly captures that idea. A company with, say, 5% growth might be a nice little business, but it's not a rocket ship. It's just not going to reach orbit. As O'Neill himself put it, that level of growth is insufficient to fuel a major price movement. To get the kind of explosive stock performance we're after, you need that explosive growth to match.
But a big growth number, that's not the whole story. And this next point is what really separates the pros from the amateurs. Imagine a company reports 50% earnings growth. Sounds amazing, right? But what if last quarter they grew at 100%? Well, that's actually a sign of slowing momentum. And this is exactly why we have to look at acceleration.
And here is a pro-level technique to do just that. It's called the acceleration check. It's actually pretty simple. First, find the latest quarterly EPS growth number. Then compare it to the quarter before that, and the one before that. The key question is the rate of growth itself getting faster? A company that's accelerating from 20% to 35% to 55% growth? Well, that is sending one of the most bullish signals you can possibly find.
Finally, we have to play detective for a minute and confirm the quality of these earnings. The key is to look at sales growth. See, if a company shows huge profit growth but its sales are flat, that is a major red flag. It usually means they're just aggressively cutting costs, and that's a trick that can't last forever. What you really want to see is strong sales growth, ideally 25% or more, right alongside that powerful EPS growth. That's the sign of genuine, sustainable demand.
So this brings us to a really crucial mindset shift that trips up a lot of investors. We're often taught to hunt for cheap stocks with low price to earnings, or PE ratios. Well, the CAN-SLIM philosophy is pretty radical here. You should mostly just ignore the PE ratio. Your entire focus should be on the rate of earnings growth and its acceleration, not on some superficial measure of cheapness.
And look, this isn't just a theory. It's based on tons of historical data.
O'Neill's research concluded that PE ratios had almost nothing to do with which stocks became the biggest winners. In fact, he found that the lowest PE stock in a group is often the weakest company with the most ghastly earnings record. And why is that? Because truly great companies are in high demand, and they're almost never cheap.
All right, theory is one thing, but let's see how these rules actually work in the real world. We're going to look at a classic case study that shows exactly how the C criteria can spot a supernova before it ever takes off.
Let's rewind the clock back to 1999 and take a look at Qualcomm. Before this stock went on this just unbelievable tear from a split-adjusted $750 to $200 in just 1 year, what were the earnings telling us? Well, they were reporting massive and, more importantly, accelerating quarterly earnings growth. The C was just flashing bright green. The clues were right there for anyone using this system to see.
All right, we've covered the theory, and we've seen the proof in a real-world example. So now it's time to put your knowledge to the test. Let's do a quick quiz just to make sure these core ideas are locked in.
Question 1. According to all the historical data, what is the absolute minimum quarterly EPS growth you should be looking for? Is it A, 5%, B, 10%, or C, 18%?
If you said 18%, you got it. You were absolutely correct. And just remember, that's only the price of admission. The real pros are often looking for 25, 30%, or even more.
And question number 2. Which one of these is the more reliable signal of a potential big winner? Is it A, a low PE ratio, or B, accelerating EPS growth?
The answer is, without a doubt, B, accelerating EPS growth. Remember, the PE ratio is so often a trap. Focusing on it can lead you straight to mediocre companies, while the real leaders just pass you by.
And there you have it. You've now mastered the first and most critical letter of the entire CanSlim system. So to learn all 7 letters and build a complete understanding of this incredibly powerful strategy, make sure you subscribe so you don't miss the rest of this series. Next up, we are tackling the A in CanSlim, annual earnings growth, which is the perfect partner to everything we've learned today. You can click the link right up there on your screen now to jump straight to that explainer. Thanks for watching.